Slideshow. Oof. And let me go back to the beginning. In the beginning. This thing is not reading my commands here. Come on, come on, come on. Oh, for some reason, it's not reading the commands. Okay, I got to go up the hard way, I guess. All right, there we go. Okay. Statement of cash flows. Statement of cash flows. What this is going to do is tell us how this company used its cash during the period. It's a financial statement that companies print out that is going to be part of their 10K. And it's a very important report for potential investors. And we learned earlier in the course, there's three kinds of cash flows. There's operating, Coca-Cola sells soda. And then there's investing, where perhaps you buy another company's stock, or more likely, you buy a big piece of equipment, that's investing. And then there's financing, which is a fancy word for borrowing, okay? And they're making a wisecrack down here that Wall Street analysts consider cash flow and its various sources an important indicator of a company's financial health. They're going to warn us later. Companies that are showing a profit, but their cash flow is not good, you need to be wary of that, okay? All right, well, we know what cash is. Cash is money and coins and checks and direct deposits and very short-term CDs and credit cards and etc. Short-term, highly liquid cash. And this is what we were just babbling about. Operating activities, operating cash flow related to the normal business. Anything related to selling soda is operating. Investing related to productive facilities. That's a fancy way of saying fixed assets and buying stock in another company. And then you have financing, which is borrowing. Now, wow, look at this, huh? Look at that cash flow statement. That's what we're going to learn, huh? How to put this all together, okay? So let's start by getting a little more background, then we'll divide and conquer. Cash flows from operating activities. Customers, if we invest money in an investment, that's a cash inflow. Outflows, we know what outflows are. We buy things, we sell things. Net cash flows, huh? Cash goes up and down. Investing, this is money we receive when we sell one of our investments, be it a piece of equipment or treasury stock, like we learned in the prior chapter. Outflows, well, outflows mean any cash that goes out the door in terms of buying an investment. We buy a bunch of forklifts. We buy stock in Apple. That is investing. And look at the financing. It's borrowing. You borrow on notes, mortgages, bonds. Issuing stock, that's another way to raise money by financing. Outflows, well, you got to pay interest. Maybe you're going to repurchase the stock and you might pay dividends. Those are financing. So when you're doing your homework, be clear what's financing, what's investing, and what's operating. And here they're just showing you a super summary of what we're trying to get at here, Brianna, okay? Cash at the beginning of the month was 18,267, okay? At the end of the month, it was 29,932. So this means that the cash went up by 11,665. 11,000, we'll say 665. Well, what management wants to know is how much of this was generated operationally. Did we borrow? Did we have some unusual things? And that's what the cash flow statement is going to tell us. So if you go into a meeting with your boss at month end and you tell him, wow, we did great, boss. We generated through operations 53,269. He or she'll look at that, but their eyes are going to be drawn to the net increase if it's only 12. If we had $53 million that we raised through operations, how come cash only went up 11? Well, because don't forget, boss, remember we bought that gigantic building? Remember we invested money in Coca-Cola? And don't forget, boss, one reason we were able to increase the cash is because we spent 30 million on borrowing, which we used to do a few things. So the cash flow statement essentially is going to take the change in the cash and break it into these three categories. Relationship to the balance sheet and the income statement, okay? In order to do a cash flow statement, this is exactly what you need. You need the income statement for the current year. And you need the balance sheet for the current year and the balance sheet for the prior year, comparative balance sheets. You need those two to get started, and then additional details in certain accounts. Let's concentrate on what you need. You need one income statement from the current period plus this year's balance sheet juxtaposed with last year's. Line them up next to each other. Relationship to the balance sheet, cash equals liabilities plus equity. I think we know that. I don't know where that's there, okay? Okay, relationship to the balance sheet, okay? I think we know if we collect money, cash goes up, we pay somebody, cash goes down with prepaids. You don't need to take an accounting class to know this, okay? What's going to be important, though, is how they're signed correctly in the cash flow statement. So here is the first thing we need to prepare a cash flow statement, a comparative balance sheet, huh? National Beverage out of Baltimore. And there's the income statement. And the income statement is going to be, of course, giving us the net income, which will be the first line of our cash flow statements. And they're talking about two methods, direct and indirect. I'm going to go over the indirect method, which is the one that everybody must use, I think, on their financial statement. In fact, I know you do. The indirect method. And we're going to turn the accrued, let me just move this out of my way. What are they trying to tell us? No matter which form it's used, the same amount of cash flows is, you're going to get the same amount of cash flows. It's just that the indirect method shows the detail, and the other one is just a kind of a summary. It's almost like you're copying from the cash account in the general ledger. And I'll go over that toward the end of this if you like. Direct method versus indirect. The indirect method adjusts net income by eliminating non-cash items. So let's not get scared of this too much. All that means is we're going to start our cash flow statement with the net income. And as we know, everything we've been doing in this class is on an accrual basis. So we're going to start our cash flow with the net income, and we're going to get rid of the non-cash expenses to turn that net income into the cash income, if you will. Okay. Gains and losses. We could probably go over this a little bit later, but if you had transactions that cause gains and losses, they should be traded. They should be shown on the statement as operating cash flows, investing or financing, depending on what they are. A sale of equipment produced a gain that would be classified as an investing activity. And we must eliminate gains and losses from the net income. reporting and interpreting cash flows. Here now we get into the beginning of some tricky stuff. I always use this word, intuitive, counterintuitive. Look at what we have here. We have current assets and current liabilities. You are going to take the difference in the balances between those two balance sheets and come up with a number. They're looking, let's pretend that this is accounts receivable, okay? Accounts receivable. If accounts receivable increased, that's a negative cash flow. I'm going to repeat that. If a current asset increases during the month, that is a negative cash flow. And the reason that is because an asset can only go up if you buy something, right? So an asset going up is a negative cash flow. So think about it in terms of accounts receivable. If accounts receivable went up, you didn't receive any cash in that transaction. You're trusting this customer to pay you later. That's a negative. I'm so sorry, guys. That's a negative cash flow. Think of it this way. If a current asset goes down, it's a positive cash flow, and you're going to add it to that income number. Accounts receivable. How does accounts receivable decrease? Hopefully by getting paid by our customers. So if accounts receivable goes down, that is a positive cash flow. If inventory goes down, that is a positive cash flow, because the only way the inventory goes down is you sold something. Okay, so we're going to get this little relationship on current assets in our head. Okay, assets going down is a good cash flow. Okay, you don't want your assets to just grow and grow and grow and have a pile of assets that aren't doing anything for you. You want to be selling them. You want to get them turned into cash. So use this table when adjusting net income to operating cash flows. All right, look at this. Look at this. Here is the cash flow for National Beverage Corp. Okay, so let's see what they started us off with. They gave us an income statement. In that income statement, 43. I hope that's not a different number. If it is, I'll look like an idiot again. Yeah, 43,635. Okay, there is our net income. Well, when they brought it over here, some brain put 45,635. So we'll go with either number. First thing we need to do is, and I just want to back up once more here. Okay, here we go. All right. First thing we need to do, we start with the net income, and then we add back to the net income non-cash expenses, depreciation and amortization. Okay, we're going to add those back. If we had a gain on the sale of an investment, that would be a number that we would have to subtract out of here. So just to get started, net income plus your non-cash expenses. Now, the next thing is adjust net income by eliminating the gains and losses. And we're going to look at the balance sheet. Now, I do not like these slides. I don't like these slides at all. And I'm going to show you why. Oh, here we go. Okay. Here is the change in income. It went up 11,665. Look at accounts receivable, in inventories, and prepaid expenses. Those are operating current assets. Short-term investment is not operating. So we're starting with the net income, plus our non cash expenses. Take a look at accounts receivable. Accounts receivable went down, and the other two, inventory and prepaids, went up. So AR went down and the inventory and prepaids went up. So what is our rule? If an asset, current asset, goes down, that is a positive cash flow. Inventory and prepaids went up. They are negative cash flows. Negative cash flows. Now we have to do the same thing with our current liabilities, but it's a little bit easier because you don't have to worry about the opposite sign control, plus minus, because with payables, if accounts payable goes up, that is a positive cash flow. If accounts payable goes up, it's a positive cash flow because we received some assets probably and didn't have to pay any cash. Same thing with an accrued expense. We're recognizing an expense that we have to pay in the future. So if accounts payable went up, that is a positive cash flow. What reduces accounts payable? What reduces accrued expenses? When you make the payment. So let's take a look at the number here. Payables went up. That's going to be a positive cash flow. And the other one went down. Ooh, that's bad because we actually paid somebody. So cash flow wise, that's not good, okay? So here we see the three current assets, and now you see the payables coming in here. Remember, AP went up, positive. The accrued expenses went down, negative cash flow. So take a peek at this. This is the first part of three parts of the cash flow statement. And you're going to need to just work through some of these issues here. This could be a little bit tricky. Cash flows from operations. When I used to have to do these things in pencil, God almighty, years ago, this could be a real pain in the neck to get done. But let's understand the basics here. Net income plus your non-cash expenses. They don't have any gains or losses here. Net income plus depreciation and amortization, plus or minus the differences in the current operating cash, operating assets. And here we go. Net income plus that, there is our cash flow provided by operations. 53,269. And again, they're reminding you to have this in front of you until it's intuitive, until you just know it. If an asset, a current asset, we're only talking current assets and operating, if a current asset increases, that's a negative cash flow. A current asset goes down, that is a positive cash flow. Because current operating assets go down only when somebody pays us, okay? So this is a good slide here, and this is really true. Interpreting cash flows, a common rule of thumb followed by financial and credit analysts. Avoid firms with rising net income, but failing cash flow from operations. That's a real red flag. They're reporting that they're making money, but they're running out of cash. And generally speaking, would you invest in a company if they do not believe, if you don't think that the cash generated from operations is going to be available to pay the dividends or expand the company? Okay. Creditors will not lend money if they don't believe that the cash flow from operations is going to leave them with enough money to pay back the bank. So investors, they look at the balance sheet, they look at the income statement, they'll glance at the equity statement for sure, but they'll really hone in maybe on the cash flow statement. We can consider this the fourth of our financial statements. As you know, we're not going to worry about the international perspective. So let's take a look here. We took care of the cash, of course, and we just took care of the operating current assets and the current liabilities. Now look what they're showing us here now. We have to now go back and see which current assets we have ignored till now. And we ignored the short-term investments because that's clearly an investing cash flow, and net equipment, meaning original cost minus accumulated depreciation. That is also an investment equipment. So let's see what we have here. Well, short-term investments went down and equipment went up. You are not going to take that difference and bring it over to the cash flow, because with investments and financing cash flow work, you have to show the detail by going into the general ledger and what I call pick the bones. We have a short-term investment that changed by 980 and equipment by just about 2 million the other way. Okay, so let's see what we have here. We must report the cash used to purchase the equipment separately from any proceeds we received in the sale. In other words, you can't go up here like you did with the current assets and say, well, equipment went up 2 million. That's a negative cash flow. No. You have to show the plus of the investment that you made in cash and how much you got back in cash in terms of perhaps a sale of a piece of equipment. The only difference between operating and financing and investing cash flows is that the financing and investing require detail. Okay, we must report the cash we used to buy the equipment and also show on this thing the cash we received. So here we go. Company purchased new equipment for 12,124, huh? And sold old equipment for 62. We have to show the detail. Now I know these numbers don't agree with the earlier balance sheet. That's for another time. But the point is here: the company purchased new equipment for 12,124, and they sold the old stuff for 62. On your cash flow statement, you have to say cash flows from investing, and then tell us what happened. Well, we purchased property and equipment, but we also sold some property and equipment. If you buy property and equipment, that's a negative cash flow. Would you agree? And if you sell something, that's a positive cash flow. So with investing and financing, you don't have to worry about this sign control business, okay? So that's the detail on the investing portion attributable to the equipment. Now you remember up on our balance sheet, we had short-term investments. And it looks like the short-term investments went down, okay? Well, you can't just bring this 980 over. Cannot do that. You have to know the detail of the 980 in terms of cash inflows and outflows. And the only way you're going to get that is from the general ledger. And on the test in your homework, they're going to give this to you. They're not going to make you do too much digging into the general ledger. So here we go. Although short-term investments is a current asset, it's reported in the investing section on the statement of cash flows. So now we have to do Mr. Yellow here, huh? And I like to go back to that number again. This is my style. I want to see it again. 980. Let's see if this one agrees. 980. Okay. Let's take a look at this. 980 was the change, but let's see. How much did we purchase? We purchased 2.443, and I'm sorry, we purchased 1463, and 2443 in short-term investments were sold. So the 2443 is obviously a positive cash flow. We sold something, and here we bought something. So there's your 980. There's the 980, 2443 minus 1463. This portion here, the investing, you got to pick the bones, and they're going to give you the bones for the most part. Okay. When you're doing your homework, they're going to make you go into the T accounts, the general ledger, and you just got to look through it. Okay, we had 2 purchases and 1 sale. Add the 2 purchases up to get the total cash outflow for investing. Free cash flow is kind of interesting. Cash flow from operating activities minus dividends and capital expenditures gives you a number that generally measures a firm's ability to pursue long-term investment opportunities. That's a formula. We want to know that. Not that hard. Free cash flow, operating minus dividends and capital expenditures. Now they're highlighting 3 things we've not done yet. So far, we covered all of the assets and all of the liability, the current liability. Now we've got some long-term debt, and we've got contributed capital, which is probably from a stock issue, and we have additional paid-in capital. We have retained earnings. We must see what's going on with those. Again, we must get the detail. So let's see what happens here. We have a difference of 22,772. Company used, they're making it easy for us. The company said that decrease in notes payable is because we paid it down. So that's easy enough. You bring over the 2272. The company used cash to repay that amount, 22772. Now, if they had also borrowed money, you'd see a second line there that said borrowing, and that would be there as a separate item. Let's look at the next one. Let's see. Here are the bones. They're giving you the bones. Look at them bones, huh? The company repurchased some treasury stock. That is a negative cash flow. Okay? If they had also sold, say, $10,000 worth of treasury stock, you would see a line here that says sold treasury stock. All about the detail. Let's see what else we have. Whoa. The retained earnings account increased from 37 to 80 due to the combined effect of the income and dividends paid. Okay, so we had dividends of 726. How come we don't put the net income here? Because it's up here. It started up here. The net income is the start of the indirect method cash flow statements. So we now accounted for the difference in the retained earnings. I want to go back here again. Hold on. This little, I'm getting a little, I don't know if this is I don't want to say malware. I'm getting a little interruption here. Okay. So here we go. We have 53,000 in operating cash flows, positive, offset by some investing and borrowing. We add them all up, and that's going to be the change in the income. Interpreting cash flows from financing. The long-term growth of a company is normally financed from three sources: internally generated funds. You start a business, you start a corporation, you're rich. You start a corporation and you throw $1 million of your money in there. That's internally generated. It's owner's contribution, right? Contributed capital. And then after that, you issued stock to raise money, and you also borrowed money. Three cash flows from financing. And then when you're paying them back, obviously that's a negative cash flow. The statement of cash flows shows how management has elected to fund this growth. And this is information used by analysts who wish to evaluate the capital structure and growth potential of a business. So if you have a business and your cash flows are constantly negative operationally, and you're borrowing and borrowing, that's not a good sign for the investor. Now we're back to our cash flow statement. We had just finished putting in the 726 for retained earnings. 53,269 operating minus 11,082, which was a negative cash flow for investing, minus 3,552, which is the negative cash flow for financing. You net them together and we get a number here, 11,665. 11,665. Do you remember that number? That was the difference in the cash. The difference in the cash. Remember, the cash went from like 19 to 18 something to 29. That is the difference in the cash. So if we've done everything correct on this cash flow statement, starting from net income all the way down to the 11,665 number, that 11,665 should equal the difference between the cash at the beginning. It's right in front of me here, right? The cash in front of it, the cash at the beginning, 18,267, subtracted from the cash at the end. So, like I said, management now has this document in front of them. Investors do, and they're saying, "Holy cow! This company generated 53 million from operating, and they use a lot of that. It looks like to borrow and invest on a very superficial basis. This is a nice looking cash flow statement because most of your cash flows are from operating. If you saw negative cash flows from operating and then big borrowing numbers, that could be a red flag. That could indicate they're getting a bit on the desperate side. Okay. Completing the statement disclosures at the end of the month in their annual report, the 10Ks, they're required to reconcile the net income to cash flow from operation, non-cash investing activities, cash paid for interest. It's kind of what we just did. That's what we just did. And I'm not going to go into supplement B. Just going back to the beginning. So the cash flow statement, it's a matter of divide and conquer. Divide and conquer. Let's concentrate on the first part. The first part, which is operating. Net income. Come on. And thought I'd never get back there. Divide and conquer. The first part is the operating section. And I think that's probably the most difficult because you have to be clear on the relationships of the current operating assets and current operating liabilities. Asset goes up, add cash flow. And maybe use accounts receivable as the paradigm. That one's easy to understand. Well, accounts receivable went up. That didn't do us any good cash-wise. In fact, it kind of hurts us because we just gave away our product for free to somebody, trusting they're going to pay us in the future. But when they pay us and we can reduce accounts receivable, that's positive. On the investing and operating, you just got to show some detail. Investing, what did you buy? What did you receive in? Short-term investments, the same thing. What did you buy? What did you bring in terms of cash? Financing, well, if you repaid some debt, that's obviously a negative cash flow. If you purchased treasury stock, negative cash flow. If you sold treasury stock, which they did not do here, that's a positive cash flow. And dividends, of course, are a negative cash flow. So hopefully I got you guys started in terms of understanding the basics of this cash flow statement. On the test, there could be a lot of questions along the lines of inventory went up $10 and accounts receivable went down $10. What was the total cash flow? The answer would be 20 unfavorable because the inventory went up, which is bad, and the accounts receivable went down, which can only happen with a negative cash flow, spending money, okay? Anybody out there in the class? How about the lady in the back right row there? Brianna, you have a question?
No, no questions.
Do you find this pretty daunting right now, or it seems pretty reasonable?
Reasonable, just have to remember the, relationship in the assets, so.
Yeah, that's the only clunker. And I guess this is a good thing. If you make a mistake with the sign control, you'll pretty much know it right away on some problems. So, okay. Well, that was a little shorter of a class than I expected there, but so you have no more comments then, huh, Brianna?
Not related to this. I just for Friday's class, are we gonna kind of just prepare for the exam?
Absolutely. Absolutely, everybody. Friday, we'll have a test review. I'll go through all the chapters that are on the test. I will answer any questions you might have. And if you want to email me or text me questions in advance, maybe I can prepare for it. But yeah, I'll go through whatever you guys need on Friday, okay?
Awesome, thank you.
All right, well, say hi to everybody, okay?
All right, have a good one.
Hey,
See
you
you
too.
Friday.
Bye-bye. And I guess that will be the end of our class. Remember Friday, big test review. And there's a lot on this test, huh? There's a lot on this. I believe we're going to be testing on the bonds. Am I right on that? Present value, bonds, got all this stuff. So hopefully you have a good session on Friday. Hey, take care, everybody. We'll see you Friday.